You might have woken up this morning seeing a whole lot of red in your portfolio. What is the reason? What is causing it? And most importantly, what do you do about it? Today, we're going to answer all those questions and show you 6 share purchases that we made today because of it. So stay tuned and let's get started. All right. Let's break this down and let's make this as simple as possible. This is Casual Cash after all, where we discuss and go through financial matters like you're chatting to a friend over lunch. First thing is first, you may have seen that the markets are tumbling this morning. You may have even gone online to see if you could find out why. Let's go through what's happening in the world, my personal view on it, and in my own experience, what I'm doing to make the most of it. Okay, if you've been on this channel before, we have been speaking this year about the unique set of financial conditions we find ourselves in. So why are the markets so red? Well, here's the reason. It's a combination of economic factors, both locally and abroad. Almost every country this year is experiencing extremely high inflation. During COVID, interest rates were brought down to record lows to encourage consumers to spend money and keep the economy going. Well, it worked and people took advantage to buy cars, homes, luxury items, and we found ourselves in a unique situation. You see, because interest rates were so low, everyone wanted to spend their money on high credit items, so the demand for everything was heightened. But at the same time, there were shipping delays and shortages caused by COVID and lockdowns, so supply was restricted. Higher demand and lower supply almost always means higher prices for everything. That was the first step of inflation. The second step came about when Russia invaded Ukraine in February. To put a complex economic situation simply, Russia is a huge global supplier of oil and gas. When countries decided not to import the oil in support of Ukraine, the supply went down and the price of oil and other commodities went up. Now, when the oil price goes up, everything goes up, all the way down to groceries and bread and milk, because companies use oil and gas to produce and transport their goods. So here we have a situation where interest rates were low, demand was high, supply was constrained, and now we have overinflated energy prices. This is what you would call hyperinflation. Now, the best way to combat this is for the Reserve Bank to start raising interest rates back up again. So the USA and South Africa and most countries have begun raising interest rates, and for big companies it means their expenses go up because most of them have huge loans that they now have to pay more money on. So that in turn is typically negative to the market. Okay, I hope you're still with me so far, because that leads up to today where we got a double whammy. The American Reserve Bank raised interest rates by 0.5%, and on top of that, China announced they were doubling down on their lockdown restrictions after a surge in COVID infections. Now, why do these two things affect South Africa? Simply put, when the world's biggest economies sneeze, the rest of the world catches a cold. Strained US and Chinese economies affect South African trade, so our markets often follow their lead. Then, just to put the cherry on top, as you and I know, South Africa has been implementing more load shedding in the last few months, meaning higher costs for businesses and everyday people and less profits all around. So, over the last few months and especially the last few days, markets have not been happy. And there you have it, why the market is going down in a neat little box. But that brings us to our next question. As investors, what do we do about it? I can only speak from my own experience and the things I've learned over the years, and that is that when markets do well, typically individual growth stocks do well, and when markets are turbulent, the index tracking funds or ETFs tend to offer more safety. But simply put, certain ETFs and index tracking funds more often than not will have steady growth over the long term. All you have to do is zoom out on the graphs for the JSE Top 40 or the FTSE 100 or the S&P 500. There are typically always dips and then recoveries. The best way to normalize your risk is to dollar cost average. That basically means buying into index funds consistently no matter what the market is doing. Here's an example for you, right? Here, the first person has terrible timing and invests in the S&P 500 only at the top of the market right before all of the major crashes. The second person has perfect timing and invests only at the bottom of all market crashes. And the third invests regardless of the market with the same amount every single month. As you can see in a real world scenario, all of them make money, but the person who invests in the market regardless makes the most profits no matter the timing. So the point that I come to is that market conditions come and go. Right now, inflation is high and interest rates are low. In time, interest rates will have risen and inflation will lower. And one way or another, the energy demands will level out with supply. What we do have now is an opportunity, as always, to buy into the markets. Keep in mind it might go down more, which means we can keep buying in and get it at a lower price, but consistent investing should provide good results over the long term, and selling in downwards markets doesn't tend to typically give the best results. It was Nathan Rothschild who said, "Great fortunes are made when the cannonballs are falling in the harbor, not when the violins are playing in the ballroom." So with that, we're going to finish off with the trades I made today. Keep in mind, it's not easy to time the market and it may go down further, but I figured it was a good time in general to top up my investments, and I bought additional shares. So 500 Rand in the Satrix property ETF, 500 Rand in 4 banks, because often South Africa raises interest rates after the major powers do. So that's 500 Rand in First Bank and Standard Bank, Nedbank and Capitec each. I'm not too fond of ABSA. And lastly, I topped up 2,000 Rand in my S&P 500 growth fund that I have in United States dollars on Easy Equities. Like I said, these aren't timed investments, but just a good time in general, I think, to top up in my existing investments for the long term. And there you have it, the reason for the market's downward slide, why it's happening, and my personal thoughts as an investor about how to invest in these kind of markets for the long term. And that's it for today's episode. I hope you enjoyed it, and please feel free to give the video a like if you found the information helpful, and subscribe to the channel if you haven't already. But until then, I'll see you guys next time on Casual Cash. Cheers.